Welcome to Odisal Associates Accounting and Finance Tutors. Here again, we want to continue with financial ratios. In the last episode, we were able to treat interpretation of financial statement, which we stated that financial ratios is one of the ways that financial statement can be interpreted. And we ran down different types of financial ratios. Specifically, we're going to look at profitability ratios. Profitability ratios. Profitability ratios help stakeholders. When I talk about stakeholders, we are looking at shareholders, we are looking at investors, potential investors, lenders, and everyone that has one thing also to do with the business, to gain valuable insights into a company's financial performance in order to make informed decisions and drive business growth. Before now, we had heard that the objective of every business is profit. However, because of the climate change and all the rest, we have delved into sustainability reporting. But profitability still remains the basic aim of every businessman, especially in these capitalist economies. Types of profitability ratios. We have different ratios that we use to calculate the profitability of a business. In fact, it's not only one way because we have different measures for profitability. We have the gross profit margin ratio, we have the operating margin ratio, we have the net profit margin ratio, we have the return on assets, return on equity, return on sales, and return on capital employed that we normally call ROCE. Gross profit margin ratio. This measures the difference between revenue and cost of goods sold, expressed as a percentage. So we can have the formula as gross profit margin is equal to gross profit over sales multiplied by 100 over 1. This is expressing the gross profit as a percentage of sales. So for instance, if our gross profit is 50,000 naira and our sale is 100,000, we multiply it by 100 over 1 to express it as a percentage of sales. In this case, we are going to have 50%. What it means is that the gross profit we made in that business is 50% of the total sales that we made. That's what it means. Then we have operating margin ratio. Operating margin ratio equal to operating profit all over sales times 100 over 1. I'm only trying to show you this. We are going to have a live question to solve when I am done with illustrating this. These are simple arithmetic that we can compute without any problem. I want to tell you that this is not actually where the problem is in ratio computation. I can tell you an experience that I gave my students an assignment to do. And I said, instead of saying sales, I wrote turnover. And the students started calling me that, sir, there is no sales in this question. So how can we compute the gross profit margin? So I asked them, did you see anything like turnover? They said, yes, they saw. That is the sales. So you see, this is where the problem of ratio computation is. You can just see it. Operating margin ratio is equal to operating profits over sales times 100 over 1. I say it's very easy. It is for you to identify the operating profits and sales. That's where the problem is. However, I'm not going to let you continue to be confused. I will deconfuse you by telling you all these things when I am solving that omnibus question. But right now, suffice it to say that these are the formulas for this. This measures the net income generated from the total assets or by the total assets of the firm. The formula is profit after tax over total asset. Total assets is what we have at the end of the statement of financial position. You can get total assets from the asset column by adding non-current assets plus current assets. You can also get total asset by adding equity plus non-current liabilities plus current liabilities. Of course, each of these way will still give you total assets. You know the accounting equation, or what we call the balance sheet equation, which defines the status of a business, is assets equal to liabilities plus equity. It therefore means that the total assets is equal to the total of this, equity and liabilities. So that is why I said that you can get it either from the asset side or from the liability side. Net profit margin ratio. Net profit margin ratio equal to profit after tax all over sales. This ratio calculates the percentage of net profits to sales. That is to show you how many percent of sales was returned as profit after tax. The next ratio we're going to talk about is return on capital employed. Return on capital employed is operating profit all over capital employed. Operating profit is what we know as earning before interest and tax. This is true, especially when a company does not have significant non-operating income or interest income. Now, with this ratio, you'll be able to determine the return of profits to capital employed. Capital employed is made up of equity plus non-current liability that we normally call long-term liability. I will give you two formulas for calculating capital employed. The first one is capital employed is equal to total assets minus total current liabilities. With that, you can get capital employed. Or you can say capital employed is equal to equity plus non-current liability. This is capital employed also. Students always find it difficult to calculate
capital employed. But with these two formulas, it will be easier for you to handle. Just bear this in mind when you are calculating the ratio or when you are dealing with anything that has to do with capital employed. Know that it is a combination of equity and non-current liabilities. Note that the two formulas will yield the same figure. In whichever way you follow it, whichever formula you use, it will arrive at the same figure.
Return on equity. This also calculates the net income generated by equity. Of course, like I said, equity is the interest of the owners of the business in the business. And it's made up of ordinary shares, preference shares, share premium, retained earnings, and reserves. These are the makeup or components of
Equity. In the last class I had with some master's degree program, they were having doubt whether preference share
is part of equity. However, that is what the book says, and that is how it's treated. Even though it does not rank as the ordinary shares and does not have power of voting. But you can agree with me that majority of preference shareholders are also ordinary shares holders. So it is treated as part of equity. So these are different types of profitability ratios that we have looked into. One interesting thing about ratio is that you can generate any kind of ratio you want to generate. You can generate operating expense ratio where you use the operating expense over sales. It's still part of ratios. Most of the times, the management will ask you to raise or compute a particular ratio. Investors can take the financial statement and calculate whatever kind of ratio they want to calculate. All we should know is that ratio expresses relationship between two items. So it depends on what the person who is analyzing the statement wants to gain, the insight he wants to gain. So this cannot be all the ratios that can be calculated in profitability ratios. Okay, these are the basic ratios. We will also go into another form of profitability ratios, which I call other profitability ratios. Other profitability ratios. We have earnings per share, what we call EPS. We have dividend per share, what we call DPS. We have price earning ratio, P stroke E. We have dividend yield and earnings yield. Of course, these ratios are often associated to market performance.
So we'll start with earning per shares. Earnings per share. Earning per shares measures the net income earned by each outstanding shares of a company. Now, the shareholders buys shares from a company, and at the end, the company makes profit. That profit is seen as earnings. And if the profit is divided by the number of shares that the company has, it will tell you how much is made by 1 naira shares. So our earning per share will be profit after tax over total shares in issue. Now, I want to make some things clear about this. We have value of shares and number of shares. These are two different things, even though one comes from the other one. But we must ensure that when we are calculating earning per shares, we do not use value of shares, but number of shares. Now, in the financial statement, shares can be said that 1 million shares, 1 million shares of 1 naira each, and you see 1 million naira. Now, this is the unit of shares, the total unit of shares that the company has. This is the price of one share, and this is the value of one share. So, if you multiply the total unit of shares by the price of the shares, you will get the value of shares. However, in some instances, you may have the value, but you will not have the unit. So, if you have the value and you do not have the unit, to get the unit will be equal to the value divided by the price. To get the unit, the value that you have there divided by the price of the shares will give you the total units of a share that you have. Sometimes you will be given the unit, the total unit, but you don't have the value, but you have the price. So it will be you don't have the value. Value will be unit multiplied by price. Or you could get the units and the value without the price. So it will be price is equal to value divided by unit. So please, when computing earnings per shares, you must make sure that you convert whatever value you have to units if you do not have units. It's only when you are given units that you can calculate direct. So if we have share capital $500,000, and they now tell you 500,000 naira, and you have information that the share price is 0.5 or is 50 kobo. In order to get the unit of shares, it will be 500,000 divided by 50 kobo. Of course, this 50 kobo is 0.5. So, if we have this, it means that the total number of shares will be 1 million. Price earning ratio, or what we shorten as PE ratio. This measures the market price of a share relative to its earning per share. So we have price earning ratio equal to market price over earning per shares. In order to compute your price earning ratio, you must first and foremost compute your earning per share, which we have done before. So we know that one. Then the other one is market price per share. This one you won't be able to get it from your financial statement. It is always quoted in the stock exchange. So that's where you'll be able to get the market value or market price of shares of that company. So in order to compute the earning per share, the price earning ratio, you will take the market price and divide it by earning per share. Whatever you get shows that investors will be willing to pay that amount to buy shares from that company.
Dividend per share. Dividend per share is equal to dividend paid all over number of shares in issue. Again, we have come with number of shares, not just value, not price, but number of shares in issue. And we're talking about dividend paid. This is just measuring the amount of money paid out to shareholders of the companies as dividend. Remember that we had talked about earning per share. Earning talks about the total profit that was made by the company, while the dividend talks about the amount of money that was paid out to the shareholders. Now, when a business makes profit, at times it's not all the profit that is made that is paid out. There is something they call retention ratio, earnings retention ratio, or dividend payout ratio. A company makes earnings of 500,000 and they said, we're not going to pay out all the 500,000. We're going to plow back some of this earning into the business to help us operate. And they say, we're going to pay a percentage of this earnings as dividend to shareholders. So they might say, we will pay 50%. That will make the company pay out 250,000 naira to its shareholders. The other 250,000 naira will be put back into the business. They will not share it among the shareholders. So when we are computing dividend per share, we want to know how much of dividend that every 1 naira we invested in a company will return to us as investors, as owners of the business, after we have done our investment. How much is 1 naira worth of dividend going to give us back? This shows that our investment is returning something to us. Sometimes investors prefer to keep their money as retained earnings without collecting it. And the more this happens, the more the value of shares in the capital market increases. Though it is not 100% like that. But however, this is how it works. So if the company decides to pay part and retain part, we want to know how much was paid and how much we gain from every 1 naira that we receive. So in this case now, assuming that our number of shares is 1 million, our dividend per share will be 250,000 over 1 million, which will be like 25 kobo per share. What it means is that for every 1 naira share you invested, you earn 25 kobo. Now, if you bought 100 shares, the total dividend you get will be 100 times 25 kobo, which will give you 25,000 naira. Dividend yield. Dividend yield measures the dividend paid per share as a percentage of the market price. So you see, this is dividend yield, this is dividend per share over market price of the share. What it means is that if you bought these shares at a particular price in the market, the dividend yield will tell you what is your expectation of dividend that you will get at the end of the year when dividend is paid out. That is the work of dividend yield. Earnings yield measures earnings per share as a percentage of the market price. So we have earnings yield here, earnings per share all over market price. You might put times 100 over 1. There is something I want to point out here. You can look at the price earning ratio, which is market price all over earning per share, while earnings yield is earning per share all over market price. So you see that this is the inverse of the price earning ratio. What this is telling us is that if you bought these shares at a particular amount of money, you expected to get a particular earning per that share. So whatever your competition gives you is what you are going to expect to get at that market price of that shares. These ratios provide insight into a company's stock performance, returns on investment, and achieve investors' expectations. This shows how the investors will fare if they invested in that company. It's also a kind of profitability ratio. Uses of profitability ratios. Now we have identified 5 uses of profitability ratio. One of them is evaluating financial performance. Of course, we have seen it in our competition where we computed the net profit margin, the gross profit margin, return on assets, and all the rest. That is to show how the organization, the entity, the firm is performing. Then we also can use this ratio to compare with industry average. Now, we should know that every firm belongs to a particular industry. And statisticians always collect ratios of the different companies in that industry and get the average. When they get that average, it becomes the industry average. So if you compute your own company's ratio, you will compare it to the industry average to see whether you are doing well. If your ratio is higher than the industry average, it means that you are performing above average. If it is lower, you are performing below average. Another one is analyzing trends. Of course, this is very, very important for every businessman that you want to see your progress over time, how you have been doing. That's why most of the times we give 5 years uh, financial statement comparison to see how we have been doing in all these years. So we can also use it for trend analysis. Then we use it to make investment decision. If a company is not doing well, is not making the net profit margin is very low, would you want to invest in that company? Of course, no. It's only when you see a good company with good net profit margin that you say, okay, let me invest. And again, we have seen if a company doesn't pay out dividend, in, year out, they don't pay dividend. For those who want to get cash, they will not want to invest in that company. It's only those who want their capital to grow that will want to invest in the company. Of course, we know that when you invest, you either get dividend or what is called capital gain when your shares appreciate. So for those who want to get cash through dividend, if the company is not paying dividend, they will not want to invest. And then finally, it helps the company to improve in their operation. If the company says that their ratios are not good, they will do something to improve in their managing of resources. Say, for instance, you have a very bad gross profit margin, very low gross profit margin. You want to look at your cost of sales to see how you can reduce it. Of course, we know that profit is equal to total sales minus total cost. So you can increase sale to increase profit or reduce cost to increase profit. So if you see that you are not doing well, your profit margin is not okay, you will strive either to increase sale or to reduce cost, which is part of improvement. So this is about profitability ratio. We are going to go to another class of ratio. Okay, we are going to go into liquidity ratios. Liquidity ratios are financial metrics that measure a company's ability to pay its short-term debts and obligations using its liquid assets. These ratios help stockholders evaluate a company's liquidity position, cash management, and overall financial health. We're going to look at current ratio, quick ratio, or what is called acid test or liquid ratio, and cash ratio. Current ratio. Current ratio measures the company's current assets relating to its current liabilities. That is, current ratio is equal to current asset over current liabilities. This ratio is expressed in proportion 1:1, 2:1, or so. The current ratio is telling you how many times the current assets covers the current liabilities. So in this case, 2:1, it means that your current asset is 2 times your current liabilities. And in such a situation, you will not say that it's a bad situation because your current asset is able to take care of your current liability twice. So it can pay your current liabilities 2 times. So we will not say it's a bad ratio. Now, the next ratio is quick ratio. Quick ratio. Or acid test or liquid ratio. These are names that you can also use to talk about quick ratio. It's almost like the current ratio, but however, the quick ratio considers items that can be easily converted to cash. The more liquid the items are, the better they are. So in this case, in the current assets, we have a slow moving asset there that is not included in the computation of the quick ratio or in the computation of the current asset. That is inventory, or what we normally call stock. So in that case, quick ratio will be equal to current asset minus inventory over current liabilities. So at this point, we have seen that we are removing this item. What it means is that we feel that our inventory will remain in our store or warehouse until a third party comes to buy it, and there is nothing we can do about it. However, in things like debtors or receivables, as the case may be, it's easier to convert to cash. You can even discount them. So because of that, when investors want to find out how liquid a company is, they tend to remove that current, they tend to remove inventory from current assets to only look at uh, fast moving current assets. So that is why it is computed. And most of the times, people prefer quick ratio to current ratio. If you have a high quick ratio, it means that the company is liquid and can meet up its short-term obligation as and when due. And this is what sustains the business in the short run. A company that cannot pay their short-term obligation will find it very difficult to even make profit or to continue to move forward. So that is why people rely more on quick ratio. We're going to look at the difference between quick ratio and current ratio later. The next ratio we want to talk about is cash ratio, which measures the company's cash and cash equivalents relative to its current liabilities. So cash ratio is equal to cash and cash equivalent over current liability. Comparison between the quick ratio and current ratio. We first start with similarity. They are all liquidity ratio, measuring the ability of the firm to pay its short-term obligation as they fall due. And the two ratios use current asset and current liabilities. The differences are: one, inventory exclusion. In current ratio, they include inventory. In liquid ratio, inventory is excluded. Reason being that inventory cannot be quickly converted into cash or liquid. Two, liquid assets focus. Liquidity ratio focus more on liquid assets, the assets that are more liquid than the other ones. So that is one of the things that makes it different from current ratio. Liquid ratio is conservative because they only focus on the asset, the current asset that can be easily converted into cash. When do we use current ratio and when do we use quick ratio? We use current ratio when we want a broader measure. We want to use a broader measure of liquidity of the company. That will now include all current assets, whether they are easily converted to cash or not. While quick ratio is used when we want to be more conservative and focus more on the liquidity of the company, the most liquid assets of the company. Uses of liquidity ratios. I've identified 5 uses of liquidity ratio. One is evaluating short-term solvency. Of course, ratio indicates, this ratio also show whether a company is a going concern or not in the short-term period. So we use it to evaluate such, whether the company is solvent or is insolvent. Two, it assesses cash management, like we saw the cash ratio. We want to see how the company is able to manage their cash, whether they have enough cash to pay their current liability. Because all this one we're talking about, it is money or cash and cash equivalent that we use to settle liability. Because, like I said, even though I said that debt or receivables can be converted to cash faster than inventory, it will still take a process. Even if you want to go and discount your invoice in the bank, it takes processes, especially in Nigeria, where you are expected to fill so many forms, go to so many people before such is done. So, but the cash management ratio is telling you the cash you have as against the current liability that you have to settle. If you have a good cash ratio, it means that you can pay off your current liabilities without blinking an eye. Identify potential liquidity issue. Any company that has liquidity issue must find a way to solve that issue immediately. If not, the people that are owing will not allow the business to move forward. They can even sue them. So if you are able to compute your liquidity ratio, you'll be able to find out whether you have liquidity problem or not, and take steps to right it. Then you can compare with industry average with your liquidity ratio. How liquid are other companies in the industry? Are you above average or below average? And then it will help you to improve. And then lastly, making credit decision. Liquidity ratio computed is not only for the company or the reporting entity, but those dealing with the company can also compute their liquidity ratio to find out whether, if they give them short-term credit, whether they can get their money as and when due. So it will help the customers and the suppliers of the company to deal with the company, knowing what their liquidity is. So this is how far we have gone in financial ratios. The next thing I'm going to do is to solve a full question so that you see how all these ratios are applied. And then the interpretation of the figures that the ratios will yield. Like I've told you, it is not just computation of the figure that is important. What is important is how you interpret the figures that you have calculated. So don't go anywhere. We'll come back to solve all those questions. Thank you very much.